Two friends started investing on the exact same day with the exact same $100,000. One of them poured it all into real estate, rental properties, down payments, tenants and toilets, and 3 a.m. phone calls about a broken water heater. The other one did something almost embarrassingly simple. He bought a single low-cost index fund. And then he did absolutely nothing. For 25 years. 25 years later, one of them was significantly richer than the other. And the answer is going to surprise you. Because it's not the one the real estate gurus have been screaming about on your feed. It's not the one your uncle swears by at Thanksgiving. The truth about real estate versus index funds is more complicated, more honest, and more useful than anything either side wants to admit. Today, I'm going to settle this debate with actual numbers. The real returns. The hidden costs nobody mentions. The secret weapon that makes one of them dangerous and the other one boring. And by the end of this, you're going to know exactly which one will make you richer based on the kind of person you actually are. The fourth factor in particular is the one that quietly decides the entire fight. Let's get into it. Before we put these two in the ring, you need to understand why this debate gets so heated. Real estate people think index fund people are naive. Index fund people think real estate people are delusional. And the reason they can never agree is that they're measuring two completely different things. Real estate people brag about the value of their properties. Index fund people brag about their account balance. But neither one is telling you the full story. Because real wealth isn't about what you own. It's about what you keep after all the costs, all the taxes, all the effort, and all the years. So let's stop arguing and start counting. 6 rounds. 1 winner. Let's go. Round 1. Raw returns. This is where most people start, and it's where most people get fooled. The stock market, measured by the S&P 500, has returned about 10% per year on average over the last century. After inflation, that's about 7% in real purchasing power. That's the boring, reliable, century-tested number. Now let's look at real estate. Most people assume housing skyrockets, but the actual data tells a different story. Over the long run, home prices in America have appreciated only about 3 to 4% per year. After inflation, that's barely 1%. Read that again. On price appreciation alone, housing barely beats inflation. So on raw appreciation, it's not close. The index fund destroys real estate. A house mostly just keeps pace with the cost of living. The stock market actually grows your wealth. But if the story ended there, nobody would ever buy real estate. And clearly, people get rich in real estate all the time. So something is missing from this picture. Something huge. And that something is the most powerful force in the entire debate. Round 2. Leverage. This is real estate's superpower, and it's the thing index fund purists conveniently ignore. When you buy a house, you don't pay the full price. You put down 20% and the bank covers the rest. But here's the magic. You control the entire asset. You keep 100% of the appreciation. Let me show you why that changes everything. Say you buy a $400,000 house with $80,000 down. The house appreciates a modest 4% in a year. That's $16,000 of appreciation. But you only put in $80,000. So $16,000 on $80,000 is a 20% return on your actual cash. The house went up 4%. Your money went up 20%. That's leverage. The bank's money did the heavy lifting, and you pocketed the gains. Try doing that with an index fund. You generally can't borrow 80% to buy stocks. And if you tried with margin, one bad month could wipe you out completely. Real estate lets you safely control a massive asset with a small slice of your own cash. And when you add rental income on top of the appreciation, the returns get even better. This is the entire reason real estate has minted so many millionaires. Not because houses are magic. Because leverage is. But leverage cuts both ways. It amplifies your gains, but it also amplifies your costs. And those costs are where real estate hides its dirtiest secret. Round 3. The hidden costs. This is the round that real estate gurus never talk about, and it's the one that destroys most amateur landlords. When you buy an index fund, your cost is almost nothing. A good fund charges you about $3 to $5 a year for every $10,000 invested. That's it. No maintenance, no phone calls, no surprises. But real estate? Real estate bleeds money in a dozen ways the brochure never mentions. You pay property taxes every year. 1 to 2% of the home's value. Forever, you pay maintenance. The rule of thumb is 1 to 2% of the value every year for repairs, roofs, water heaters, and the thousand things that break. You pay insurance. You pay for vacancies when no tenant is paying rent. You pay a property manager 8 to 10% of the rent if you don't want to do the work yourself. And when you finally sell, you hand a real estate agent up to 6% of the entire sale price just to get out. Add it all up, and a huge chunk of your real estate returns quietly evaporates before it ever reaches your pocket. The house on paper looks like it's winning, but the house in reality is leaking cash through holes you can't see. The index fund, meanwhile, just sits there. Silent, cheap, frictionless, growing, but money isn't the only cost. There's a second cost that almost nobody puts a price on. And for most people, it's the one that actually matters most. Round 4. Effort and time. This is the round that decides the entire fight for the average person. An index fund requires zero effort. You buy it. You forget it. You go live your life. It is the most genuinely passive investment ever created. You never get a phone call. You never fix a toilet. You never chase a tenant for rent. You never lose a weekend to a flooded basement. Real estate is the opposite. Real estate is not passive. Real estate is a part-time job, sometimes a full-time one. You find the property. You finance it. You renovate it. You screen the tenants. You handle the complaints. You manage the repairs. You deal with the late payments, the evictions, the surprise expenses, the 3 a.m. emergencies. People love to call rental property passive income. But ask any honest landlord, and they'll tell you the truth. It's income, but it is absolutely not passive. So here's the real question hiding in this round. What is your time worth? If you genuinely enjoy real estate, if you like the hustle, if you want a second business, then the effort is part of the reward. But if you have a demanding career, a family, and limited free time, the effort is a brutal hidden tax that the index fund simply doesn't charge. For most busy people, the index fund wins this round before the bell even rings. But there's a twist. Because the very thing that makes real estate harder is also the thing that makes it work for people who lack discipline. And that brings us to the round that flips everything. Round 5. The behavior gap. This is the round nobody expects, and it's where real estate sneakily fights back. Here's the brutal truth about index funds. They only work if you actually hold them. And most people don't. When the market crashes 30%, most investors panic. They sell at the bottom. They lock in their losses. They swear off stocks forever. The math of index funds is perfect. But the humans running the math are not. Study after study shows the average investor earns far less than the funds they own, simply because they buy high out of greed and sell low out of fear. Real estate is different. Real estate is illiquid. And weirdly, that illiquidity protects you from yourself. You can't panic sell your house with one tap on your phone at midnight. Selling a house takes months, costs a fortune, and requires real effort. So you don't do it impulsively. You just keep paying the mortgage. And every payment quietly builds your equity whether you feel like investing or not. Real estate is forced savings disguised as a monthly bill. It turns undisciplined people into accidental millionaires, simply because they couldn't touch the money. So the index fund is mathematically superior, but the house is psychologically superior for the person who can't stop fiddling with their investments. The best asset on paper is not always the best asset for the actual human being holding it. But there's one final round, and it decides what happens when life goes wrong. Round 6. Liquidity and Risk. This round is about what happens in an emergency. With an index fund, your money is liquid. You can sell in seconds and have cash in days. If you lose your job, if you have a medical crisis, if life punches you in the face, your investment is right there, ready to help. With real estate, your wealth is trapped inside the walls. You can't sell a bedroom to cover a hospital bill. You can't liquidate a bathroom to make rent. Getting your money out means selling the whole property or borrowing against it, and both take time you might not have. But real estate carries a different kind of safety. It's a hard asset. You can touch it. You can live in it. It produces rent even when the stock market is in freefall. And historically, housing is far less volatile than stocks. It doesn't drop 40% in a single scary month. So index funds give you liquid flexibility. Real estate gives you tangible stability. Neither one is safer. They're just safe in completely different ways. So after 6 rounds, who actually wins? Here's the honest answer that neither side wants to give you. For most ordinary people, the low-cost index fund quietly wins. It produces strong returns, charges almost nothing, demands zero effort, and lets you spend your one life doing literally anything other than fixing toilets. It is the closest thing to a wealth-building cheat code that exists for the average person. If you do nothing else with your money but buy a broad index fund every month for 30 years, you will very likely end up wealthy. Period. But real estate wins for a specific kind of person. The person who has the time, the temperament, and the willingness to treat it like the part-time business it actually is. For that person, leverage turns modest appreciation into outsized returns, and the forced discipline of a mortgage protects them from their own worst instincts. Real estate is not a passive miracle. It's an active business that happens to have incredible tax advantages and leverage built in. And here's the secret the wealthiest people already know. They don't pick one. They use both. They max out their index funds for the effortless, liquid, compounding growth. And they buy real estate for the leverage, the tax benefits, and the diversification. They let the index fund be their calm, quiet engine. And they let real estate be their aggressive, hands-on accelerator. The debate was never really real estate versus index funds. The debate was always about which one fits the life you actually want to live. So here's what I want you to do this week. Be brutally honest with yourself. Do you actually want to manage property? Not the fantasy of passive income. The reality of tenants, repairs, and responsibility. If the answer is yes, learn real estate the right way and use leverage to your advantage. If the answer is no, stop feeling guilty about it. Open a brokerage account, buy a low-cost index fund, automate a monthly investment, and go enjoy your weekends. Both paths build wealth. The wrong move isn't choosing one over the other. The wrong move is being so paralyzed by the debate that you choose neither. Because here's the thing. There is no perfect asset. There's only the asset you'll actually hold through the crashes, through the fear, and through the decades. Find that one. Then, never let go. If this video helped you cut through the noise, hit the like button. Subscribe for more breakdowns like this one. And drop a comment below telling me which side you're on, real estate or index funds, and why. I read every single comment, and I love seeing how people think about this one. I'll see you in the next one.